2022 has nearly completed its term. Economies worldwide have suffered immensely in these past 12 months, even though the pandemic now seems a distant memory. The Russian war on Ukraine continues, supply chain disruptions still exist, inflation is uncontrolled and interest rates are even higher. Economies are suffering worldwide and stock markets are struggling, but all is not lost. Such times bring us a great opportunity of getting into some worthy contenders in the stock market. The key, however, is identifying stocks with strong fundamentals to weather the current storm, and come out winners at the other end. One good strategy for investing in such uncertain times is considering stock picks from investment pros. To further ease out the process for you, we have compiled a list of the top 5 stock picks from investment pros for you to add to your portfolio. Up first on our list for today is an American hydrocarbon extraction and clean energy company, Denbury Inc., trading under the ticker symbol DEN. The firm is working on both niches. On one, it focuses on conventional and enhanced oil recovery in major production fields. On the second, it works in carbon capture, utilization, and storage technologies. This enhances the company's operational sustainability, as Denbury uses its carbon capture tech to build up carbon dioxide reserves, which in turn are used in its enhanced oil recovery operations. On the financial front, the company is doing pretty well given the economic circumstances. In the third quarter of 2022, its revenue improved by a nice 28% year-over-year, to $439.5 million. The net income shot up by 203% to $250.4 million, while the profit margin rose to 57% from 24%. Moreover, net cash flows from operations totaled $156 million, and free cash flow was $47 million. Denbury ended the quarter with $724 million of financial liquidity. In the same quarter, the company inked 2 deals for the transportation and sequestration of CO2. Furthermore, the company is also working on developing a new enhanced oil recovery project, Cedar Creek Anticline in Montana and North Dakota. Production response for the project is expected in the second half of 2023. On top of it, the stock carries a buy rating from Stifel with a price target of $144, which suggests an upside of over 60% over the coming year. Wall Street also agrees with the research firm, giving the stock a strong buy rating with an average price target of $118.80. Up next is the diversified international family entertainment and media behemoth, the Walt Disney Company, represented by the ticker symbol DIS. The House of Mouse has some interesting tailwinds in the making, to propel it to new heights once again. The company has had a rough few years, owing to the pandemic and not so impressive leadership guidance, after Bob Iger left the helm. Disney stock significantly underperformed during Bob Chapek's tenure, with plenty of red ink on the income statement. Its pivot to a streaming-first enterprise, related restructuring, and expenses impacted the company severely. From disputes with governors to outrage among Disney workers, its storytelling losing the spark to theme parks underperforming severely. In the fiscal fourth quarter of 2022, revenues and earnings both missed analysts' estimates. Revenue grew by 9% to $20.15 billion, missing the mark by $1.28 billion. The earnings per share came at 30 cents, which missed the expectation by 26 cents. However, things seem to be finally on the right track now that the legendary leader Bob Iger is back. During his tenure from 2005 to 2020, Iger closed a string of deals that gave the company a coliseum of intellectual property. These included the acquisitions of Pixar, Marvel, Lucasfilm, and 21st Century Fox. He was also the one who launched Disney Plus streaming services. Moreover, the stock surged by around 400% under his leadership. Iger has already initiated his plans for returning magic to the Disney story. He has begun working on a new organizational structure, including cost reduction and a new focus on storytelling. The stock was upgraded to an outperform rating by MoffettNathanson, just near the end of November 2022. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Following next is a US-based healthcare company that develops proprietary synthetic DNA manufacturing processes, TWST Biosciences Corporation, operating under the ticker symbol TWST. The company has developed a disruptive DNA synthesis platform. It manufactures a broad range of synthetic DNA-based products for use in the healthcare industry. Bringing forward the twist, this biotech firm is also working on data storage, more specifically, DNA data storage. With DNA's high density, the company estimates a shoebox full of DNA could store all the existing data on the internet. Other factors include incredible longevity of DNA and less energy requirement. TWST has projected a $35 billion annual market opportunity with DNA data storage. While it is only in the early stages of development, this market could prove a game changer in the long term. Meanwhile, the company generates revenue from selling its products to healthcare companies. For fiscal 2022, which ended on September 30th, the company had a record revenue of $203.6 million, rising 54% year-over-year. The net loss was much better than expected at 91 cents against $1.28 per share. At the end of the period, the company had $505 million in cash and cash equivalents. TWST is looking forward to revenues of $261 to $269 million for fiscal 2023, and roughly $350 million for fiscal 2024. Additionally, what makes the stock more interesting is its outperform rating, and a potential upside of around 30% from analyst firm Baird. The stock is down by over 63% year to date, which makes it an excellent time to grab it before it surges. Up next is an energy company based in the US, Vistra Corporation, which trades under the ticker symbol VST. Its services include power generation, transmission, and distribution. The company caters to the demand of 4.3 million customers across the US, with a generation capacity of 38,500 megawatts. This energy firm is also working on transitioning its generation fleet to lower carbon resources. For this purpose, it is deploying cost-effective and strategic investments in solar and battery energy storage developments. Vistra had been working on reducing its debt from 2019 to 2020, and has since shifted its focus to increasing shareholder return. The company had placed a $2 billion share repurchase program for 2022, but by November 1st, it had already exceeded the share repurchase of $2.05 billion. It also offers a quarterly dividend with a yield of around 3.2%. This year the company has increased the dividend by roughly 29% against 2021. In the third quarter of 2022, Vistra's net income leapt to $678 million, a mammoth increase of $668 million from the comparable $10 million. Furthermore, operating revenues also made a huge jump in the quarter, rising by 72% to $5.15 billion. The profit margin improved to 12% against just 0.2%. In addition, the company also hedges significant exposure to energy prices, to ensure the stability of its cash flows against fluctuations in energy prices. Vistra carries an outperform rating from Wolfe Research, and a price target with an upside of roughly 35%. The final stock for today is the American building materials and home improvement products provider, The Home Depot, trading under the ticker symbol HD, Home Depot is the biggest home improvement retailer in the world. The company has continued witnessing momentum in both its do-it-yourself and professional businesses. To keep its customers and DIY shoppers loyal and engaged, the company is continuously adding new features to its app and launching new projects and products. Despite the global economic turmoil, the company continues to deliver sales and earnings growth. In the latest quarterly report, it came out with sales of $38.9 billion, marking an increase of 5.6% year-over-year. Net earnings came out at $4.3 billion, against the comparable $4.1 billion. Diluted earnings per share were $4.24 for the quarter, with an increase of 8.2%. Given the quarterly performance, the company reaffirmed its fiscal 2022 guidance, with comparable sales growth of 3%. However, the stock has suffered widely this year, with shares nearing a 21% drop year to date. It is just a matter of time before shares are back on track with upward movement. Additionally, Home Depot also gives a dividend with an annual yield of 2.32%. With the stock trading at less than 20 times forward earnings estimates, shares are screaming buy. TWST held a buy on the stock in November, and 89 hedge funds tracked Home Depot at the end of September 2022. The hedge funds number increased from 80 in the previous quarter. That's all from us in today's video. We hope that the insight we aimed to provide you have been of meaningful value to you, and would help you optimize your investment portfolio. We would love to hear your feedback on our list in the comments below. If you would like to know about more stocks that are suited for different investment strategies, check out our website, stockstelegraph.com.